if you are in the hallways, if you are doing Q&A, you're going to want to make your way back to have a good time. What's up, Tate? We are going to be going round robin, super speed through 12 hand-picked operators of different types of asset classes. If you have a fund, if you've got passive capital, if you're just trying to understand how other operators are killing it out there, you're going to want to come back inside. And while we let people do that, we're going to explain how this is going to run. Everybody got Hoova on their phone? Everybody got Hoova on their phone? Okay, if you don't have Hoova on your phone, turn to the person to the left or the right of you, because there's an 80% chance that they do, according to my statistics, and they can help you out how to download it. If you open up Hoova, I'm going to do this with you in real time, and you go to the agenda, make sure you're on Thursday, scroll down to the pitch competition where it says 12 sub-sessions. Pitch competition, 12 sub-sessions. Under there are 12 different categories. 12 sub-sessions. If you click the first one, passiveinvesting.com, you will see that there are 2 polls when you click on that. 2 polls. The first question is going to be, what do you think? Rate me, 1 to 5. And we're going to aggregate the results of these 12, and the top 3 are going to have bragging rights for a whole 365 days. That's their prize. The second question is, if you want to invest, if you want to drop that email and have them reach out to you, have them be proactive to you, you can drop your information if you want to have a conversation. All right, so two polls for every single one. If you want to have a say in who is the most successful pitcher in this competition, smash that star button. And if you want to drop your contact information to passively invest in the future or to just get connected in general, you can drop your information there. If you do not see the polls right now, they will open up in real time during each of the individual 12 sessions. If you try to jump ahead, you will not be able to. Each of them are there. Okay, so people in the back, if you could do me the grand favor of closing those doors, I would be greatly appreciative. If you would like to participate in the competition and you can hear my voice, or watching the competition, make your way back into Ballroom, Aurora Ballroom C and D. And with that, we're going to get started. The first person, passiveinvesting.com, they've got multiple asset classes. I'd love to introduce you to the man with the best hair in the business, Andrew, the Director of Investor Relations for Passive Investing. Let's kick this thing off.
So good to be here with you today on behalf of passiveinvesting.com, not on Zoom or Teams, but in person with you. I am the Director of Investor Relations for our group, and I'm excited to talk to you about who we are, why we exist, what we're doing, how we're doing it, and why you should invest with us. So, to start off, who are we? I had over 2,000 investor phone calls last year. And I always started with who we are. Because as you know, if you're a passive investor, who you're investing with is as important as what you're invested in, because those pro forma returns, cash-on-cash numbers, equity multiples are only as good as the team behind them. So who are we? 3 managing partners, Dan Hanford, Danny Randazzo, and Brandon Abbott. I do not have time to give you their bios today, but I highly encourage you to do some research, and when you do, you will find a deep background in business operations, running profitable businesses, a deep expertise in financial analysis and underwriting, and decades of commercial construction and asset management experience. Behind them, we have a team of 30 full-time employees. Now, why do we have that? I love this quote from Naval Ravikant. Playing long-term games with long-term people is the way to see compound returns in your investing and your life. We are building a legacy business, and our goal as a group is to build wealth alongside our investors for decades to come. So how have we done so far? 6 full-cycle deals over the last 4 years, an average net return to our passive investors, internal rate of return of 26%. Those were all underwritten for 5-year holds. We've exited all in less than 3 years and delivered above our pro forma projections on every single one. During COVID, we maintained distributions on every single one of our assets, no capital calls, no lost money, very, very strong performance to date. Congratulations, you might say. It's been a good market. Everybody's performing well. How are you positioned for the future? Interest rates are rising. There's some crazy stuff going on in Russia and Ukraine. We're a little bit concerned about where things are going. I'm so glad you asked. Our strategy and how we have shifted in light of where we are in this market cycle has moved towards higher quality institutional assets and strong primary markets. Does anybody not know what the Sunbelt markets are at this point? North and South Carolina, Georgia, Florida, Texas, and Arizona are key markets. Within those, we're buying suburban Class A deals direct from developer at a strong basis with a lot of upside in rents, as well as executing a light value add approach. And in addition to that, we're buying B and B plus class assets, 2,000 or newer, where we can also execute a value add. That's our strategy. You're going to hear the word conservative approach and conservative underwriting a lot while you're here today. We actually are. So you can see how we are in our asset selection and the markets that we invest in. The reason we like those assets specifically, they have a high income tenant base, very income stable. And we saw this during COVID. We had almost no issues with eviction moratoriums, non-paying tenants, et cetera. When you look at the performance of those assets over the last 30 to 40 years, 08, tech crash, COVID, et cetera, stable. We like these assets. Additionally, we're conservative in our underwriting. We stress test our assets down to 60% occupancy. So we know that we can get to historically unprecedented vacancy levels and still maintain our operating obligations and debt service. In addition to that, we keep ample operating reserves. So we're going to have 9 to 10 months of operating reserves against any issues that may arise in an asset. And it's one of the stated goals of our managing partners that we never do a capital call, and we are underwriting and planning for that accordingly. Okay, so you're buying high quality assets, right? But where's the upside? Does this strategy actually yield results for your investors? I'm so glad you asked. 2 deals we did in 2021. Braxton Waterley, we bought this direct from the developer, 354 unit deal for $91.6 million. At acquisition, it was our largest purchase to date. On closing day, it appraised for $103 million because we're buying these assets at a strong basis from developers that are ready to get out. And in order to get out, they are over-aggressively leasing up the units, giving away way too much in terms of concessions and incentives. And so just by buying those assets well, marking rents to market as those leases roll over and burning off those concessions, we can see massive value add. On top of that, we're creating some light value add like pet yards and first floor units, services that are appealing to this type of tenant class, and we're able to achieve significant NOI growth, significant value add in these assets without the risk, without the CapEx, and without the elongated time frame of your typical value add approach. Was this an anomaly? No, it was not. Blue Water at Bolton's Landing was the second acquisition that we did like this in September. $88 million purchase. On closing day, it appraised at $108 million. Exact same story. Bought it at a strong basis. Rents were well below market. And just by operating that asset well in the first year, able to significantly increase the NOI, revenue, and value of that property. We like markets that have strong household incomes and great locations with barriers to supply. Now, this is how we've performed. This is what we're doing. This is our strategy moving forward. But how are we treating our investors? So Dan, one of our managing partners who you'll get to hear from this week, he is an active or a passive investor, an LP in over 60 different syndications with 17 different operators. So as you might imagine, he's had varied experiences as a passive investor. No need for a show of hands, but I imagine if you've been a passive investor for any period of time and in any number of deals, you've probably had some communication issues at some point. You may have wanted to know what's going on with your asset. You may have a hard time getting in touch with the sponsor. This is one of Dan's biggest frustrations and why communication is a key value of our organization. So to date, we have over 1,700 active investors or passive investors active in our different assets. Of those, 65% are repeat investors are invested in multiple deals with us. On our last deal, which was Las Palmas that we closed in the Fort Myers market in January, 81% of the investors in that deal were repeat investors with us. We pay monthly distributions, we provide monthly communications, quarterly financials. We actually get our K-1s out on time, and we have a full-time investor relations and investor services team ready to assist you. On top of that, you might wonder, those are some early exits. What about my capital gains? Well, one of the unique things that we do in this space, because we are heavily invested alongside our LPs and we don't want to pay capital gains either, is we 1031 every single deal into another high quality asset. So on those 6 exits that we've had, we 1031 every single one of those into another deal and offered all the LPs in those deals the opportunity to 1031 with us, defer the capital gains, and continue to grow their wealth. About 81% of investors elect to do that. Usually the ones that don't, self-directed IRA investors that don't need it. So that's who we are. That's why we exist, to build wealth right alongside you, our investors. We are in this for the long term. I just got to dig into the multifamily today. We also have a self-storage fund that we launched in July that's performing extremely well, and we just entered into the car wash business. 10 to 15% cash-on-cash returns during the hold period. Performance hurdles at 20% IRR and 30% IRR. Our first car wash deal, an $8.5 million equity raise, filled up in 2 hours. Tons of demand, building a huge business here. Come by the booth and see us. We'd love to meet you, shake your hand, and I appreciate your time. Thank you so much.
Welcome. I'm grateful to be here with each and every one of you guys. My name's Steven Pesavento with Von Finch Capital, and we're in the business of buying value-add multifamily across some of the strongest and fastest growing markets in the country. We accomplish this by sourcing assets, partnering with top-tier managers, and pairing those with our clients' capital, because what we're really in the business of is delivering more freedom and flexibility for our investors so they can create the kind of life that they actually want, which all comes down to having a lot more fun. We believe that real estate is the best vehicle to create a better life, and what we're here to do in this world is to attract other successful, like-minded individuals, people who are growth-minded, who want to create a better life and believe real estate is the path towards doing that. People just like me, people just like the rest of our team. So at Von Finch means something bigger than oneself, and it really reflects our philosophy for partnering with our clients to create an impact in each of their lives. At Von Finch, why we're different is because we truly believe in value add, meaning we believe value is first discovered and then created rather than to ever be expected organically. We believe in diversification across asset type, location, and strategy. We believe in alignment with our investors, and this is core to our philosophy. Why we're in the business that we're in is so that we can create true partnerships with each and every one of you, so that when you succeed, we succeed, not the other way around. We believe in capping the downside by being conservative in our underwriting and always leaving more built-in upside on the table by having creative income growth strategies that are above and beyond the pro forma, so that we can strategically over-deliver just as we have on each and every asset that we've ever purchased. So at Von Finch, there is 2 different types of deals that we like to focus on. The first of which we call equity growth. These are deals where we're looking to create great upside over creating cash flow, and we're looking to double investors' money within a 2 to 3 year period. These are in some of the fastest growing markets like Denver, Phoenix, and Dallas, where it makes the most sense for us to go in, find great assets, purchase them, reposition them, and then eventually sell them immediately after that reposition is completed. On the contrary, about 70% of our focus is on income growth assets. These are properties that we're able to create a 6 to 8% cash flow from day one, sometimes upwards of 10. And if not from day one, then within that first year, while also being able to double investors' returns within a 5 to 6 year period. Now, these types of assets are in markets like Jacksonville, Alabama, and Houston, markets where you can find great income while also creating great back end. And what we've discovered after talking with all of our investors, many of which who've invested across each and every deal that we've done, what they've essentially created is a diversified portfolio, creating great cash flow while strengthening the upside by mixing in some of these equity growth deals. So that's really led us to offering a diversified fund that's going to be coming soon in 2022, which will allow investors to invest in each and every deal that we have within our portfolio, creating both great cash flow and even stronger back end than if they were to invest in income growth opportunities on their own. And these deals will also be located in some of the best markets across the Sun Belt, which is key to be investing in growth-focused markets. But before you get invested with anybody, you want to know where they've come from and who we are and what we're about. We've been investing for years, have bought and sold over 200 plus value-add transactions. That includes over 200 buy, fix, and resell single-family homes, a portfolio that we exited in 2019. Also includes 8 multifamily assets, over 1,300 units, over $180 million of transactions, and we've directly raised over $22 million from investors, which we've cycled through successfully across multiple assets, which we've been able to record a record of over-delivering for each and every one of our investors. Now, you might ask yourself, why multifamily now? And the truth is, in investing, timing is everything. And the multifamily market is red hot, but inflation is hotter. On the low end, we're looking at a 7.5% inflation, but for those who follow economics closely know that inflation is actually closer to 20%. Now, when we pair this with the fact that we have a huge lack of supply, a very conservative estimate from the Wall Street Journal shows 5.5 million housing units are needed today, and that number only goes up day after day. When we pair that with a lack of supply with a huge draw in demand from the 2 largest generations in our country's history, both millennials and boomers are being attracted to rent properties over owning than any other time in our history. And that's for 2 reasons. For one, it's out of necessity. They have no other choice. They can't afford it. But 2, it's out of the lifestyle that it creates. Both boomers and millennials are desiring having the ability to be flexible and move around, which is exactly why now is the time to be adding multifamily to your portfolio. So our team is made up of a great set of professionals. We've been distributed since 2016, way before it was a requirement. But we're headquartered right here in Denver. Our executives and our team is located here in Denver. And we love it when people are willing to relocate. But we don't let that stop us from hiring some of the best people so that we can continue to grow. And on top of that, we've partnered with Verivest, who handles our back office. And why is that important to an investor? Because we can go out and find great deals. We can go and partner with the right top-tier managers, and we can pair that with your capital. But if we can't deliver on the back end, the accounting, the fund administration, then what do we really have to show for it? And so by working with Verivest, they have closed billions of dollars of real estate, and we directly get to bring their services on board with us. So at the end of the day, why do people invest? They invest to create more freedom and flexibility. That's what we're in the business of creating. But we do that by delivering results. Now, of course, we've exited over 200 single-family homes successfully. In the multifamily space, we purchased a 288 unit in Jacksonville, Florida. We bought it for $27.5 million, and we were able to exit that for $37.5 million. Pretty sweet return, about 75%, and we were able to then 1031 exchange those funds into that next opportunity. Another example right here in Denver, a 40-unit property called Timber Ridge. It's now being rebranded to Midtown Plaza. You can go drive over and see it. It's about 20 minutes from here. And we bought that for $5 million. It may be a smaller asset, but in Denver, $5 million doesn't go that far. But with $1 million, we were able to turn that asset, and we currently have it under contract for $9.1 million. We were planning a 3-year exit. We are exiting in 2, so we're delivering a pretty sweet return of about 125% return. But regardless of what returns you're seeing on the board, many of the assets that we do, we like to buy and refinance. So it makes the most sense that if you align with our values, if you're the kind of person who's focused on creating a better life, you want to partner with an operator who is going out there and doing all the hard work on your behalf and only taking a win when you win, then you're going to want to talk with us at Von Finch. Because people like Darren, people like Matt, people who have experience flipping thousands of houses or are investing their hard-earned money that they've earned in military or other careers are choosing Von Finch. And one of the reasons that they choose us is because of that relationship that we're able to build. Why we're in the business that we're in. It's truly to make a direct impact. It's truly to create alignment. It's truly to create a partnership. And that's exactly why, if what I've talked about with you here today inspires you, then I encourage you to take action.
Weakest intro applause ever. They're like, Chris Benson, you're like, thank you guys, thank you. So some interesting things. They asked what I wanted my walk-up music to be. Every kid in here dreams of that moment where you're like, what is my walk-up music gonna be when I go to the plate, to the ice, whatever it is you grew up playing. I chose Money by Pink Floyd. I know it's hokey, but any other music I felt like it said too much about me, so I just went Money with Pink Floyd. I'm Chris Benson. I'm the Chief Investment Officer at Reliant Real Estate Management. We are a vertically integrated self-storage operator located in Roswell, Georgia, just north of Atlanta, about 20 miles. How many of you guys have come to the Best Ever Conference in the first or second year? Nobody. Okay, a couple. That's because there was probably only those people there. It's come a long way in what Joe and Ben have created. I'm super grateful to be a part of it. And when they asked, hey, do you want to come do a pitch session? I said to myself, all right, so you want me to pitch people on what they should invest in 10 minutes. That's how they should make their decision. I wouldn't generally recommend that your decision making is based off a 9-minute pitch. But I'm going to do my best. And what I want to start with is all of the sponsors who are going to talk to you today, and that you're going to meet in the hallway and that you're going to interact with while you're here. The thing that you want to spend the time on is really the people part of this. You are not investing in real estate. If our attorneys have done our jobs right from creating a passive investment opportunity, you have no control, and that's on purpose. And so you really want to understand the people behind the business, and a couple of the guys who just spoke have touched on it. So tonight I'm going to focus on two things. If you can walk out of here and understand team and track record for every deal that you're evaluating, that's where you start, right? Start with the team, the track record. Generally, the other stuff's going to turn out okay. So I'm going to share with you a little bit about that for Reliant. So we, as I mentioned, vertically integrated storage operator. We have 70 properties in our portfolio. We bought our first property in 2007. Reliant was actually formed in 2010, and we've been buying and selling ever since. Our sweet spot is value-add self-storage in secondary and tertiary markets. So generally, we're buying existing assets, and we're doing something to them to create value. We can't put hardwood floors, granite countertops, and stainless steel appliances in our storage units, like many of the multifamily guys do. So generally, what we're doing is adding square footage and then getting that square footage leased up. We have a fantastic team, and we've had a phenomenal track record to date. Those 70 properties represent probably a valuation of about 1.2, arguable. Everybody's got a different perspective on what their cap rate should be. We have about 180 employees. The majority of them are running the sites in the field. And you know, what I'm probably most proud of is we've never lost investor principal. We've never lost a property to the bank. So if you guys are Warren Buffett believers, usually a good start is don't lose principal, and the rest takes care of itself. Our team is fantastic. This is just some of the senior members of the team. These are the guys and gals who are making things work for you and hopefully creating value with your investments. Most of the guys on our team have an average tenure of over 5 years with the organization. Matt Blackwell, our Director of Investor Relations, is here. Michael Rieger from our Investor Relations team is here as well, and I'll be here. I hope you have the opportunity to come meet us, but really these are the people who are going to deliver the returns for you as an investor. We talked about our portfolio a little bit, just over 6 million net rentable square feet, 43,000 units. From the track record standpoint, we've had a phenomenal run in the last 12 years. We've sold 38 properties, and as I mentioned, we have not lost investor principal. Our average project level IRR on those 38 properties is a 33. So it's been a great run, but what I would say is in the last 10 years, everybody made money in real estate. You really had to try hard, excuse me, you really had to try hard to lose money. And so this is where, I think you got to think about strategy and team and how long have they been doing this to make sure that they can ride the next recessionary cycle, which, it's coming. I've been saying it for the last 5 years, and eventually I'm going to be right. It'll be here eventually. The other thing to keep in mind is average hold period of just over 3.5 years. And look, this is a function of the cycle. Cap rates have been compressing, at least in self-storage, for the past 5 years. And so we're getting values that we projected in year 10 in year 3. And that's not going to happen forever, right? And so I think you really need to think about, as you look to invest, what are the things that are driving value in the investments you're making? Is it NOI growth? Is it true NOI growth? Is it market appreciation? What has to happen? What are the levers that have to be pulled for you guys to make money? This is just detail. We'll send this out. This is on our HOVA app as well. So you can download all 38 properties we've sold, the ins and outs of each of them. There's some great stories in here, and if you stop by the booth, be happy to share. On our website, there's actually a story, the worst deal Reliant ever did. That's a great one, kind of give you some perspective as to what we've learned in our tenure as self-storage operators. And I think everybody always wants to tout the good, but generally, as you know, most of us learn from the bad, and we learned some good lessons with that one. So if you haven't invested in self-storage, there's a lot of multifamily guys here. There's really 3 pillars I want you to think about with self-storage. Historically, the average returns in self-storage have been phenomenal. The data that I'm referencing is from the National Association of REITs. The 25-year average in self-storage is just under 17% a year. And I'm sorry for the multifamily guys. Self-storage outperformed multifamily in that same period, office and the S&P 500, obviously. So with that historical return, if you believe everything is cyclical, the next thought process is, well, what happens in a downturn? 2007, 8, and 9, storage did very, very well, lost less than 4%. I'm going to touch on really quickly what happened with storage in COVID. And then more importantly, there's a huge opportunity from a consolidation standpoint in the asset class. Less than 30% of the total market is owned by the publicly traded REITs, so there's still a lot of mom and pop operators in there where we can go in and consolidate and add value to their sites. So just quick FYI, in 2020, storage did just under 13%, that's the blue bar, so it outperformed everything except data centers during the heart of COVID, and then it backed it up in 2021 with over 51% returns, again, National Association of REIT data. So what happens in storage generally is, in times of transition, you're creating demand for the asset class. We talk about death, dislocation, downsizing, and divorce. It's kind of morbid, but fortunate part about it is during a pandemic, you're usually creating a lot of all of that. And so you stuff 2 people in a house that you don't really like each other, they get divorced. Unfortunately, people get COVID, they pass away, they die. People are moving all over the country, they're downsizing and dislocating, right? So it created this huge demand, and we saw that in our own portfolio. 2021 for us was one of the best years in the history of our asset class as far as same-store revenue growth. So encourage you to look at it as a nice diversification away from housing. Talking about what we have to offer, we currently are raising capital with an equity fund, $100 million equity fund called Reliant Self-Storage Fund 3. If I were sitting in your shoes, I would say, well, what happened with Fund 1 and Fund 2? Fund 1, we actually just traded out of. Investors were in it in just about 2 years. This was one where the portfolio we had projected, the value we got last year was what we had projected in year 10. So if you came in with 100 grand in that deal, you came out with about $160,000 to $170,000 in 2 years. Now, that is not what's going to happen forever, but when it does, we're going to ring the cash register, and you guys will go along for that ride with us too. Fund 2, we launched in May of 2020. That was interesting. Right about as the pandemic started, we said, hey guys, let's raise money for self-storage. What do you think? And it was crickets for the first quarter or so. But it turned out pretty well. Right now, we're 47% above our NOI projections in Fund 2 through 2021, through December of 2021. Fund 3, we talked about how it performed during the pandemic, and I'm going to jump just because we have less than a minute. Fund 3, basically, we are an appreciation play. So you think about 4 to 7% type of cash-on-cash returns during the hold period. We project it to be a 6-year hold, and generally a 12 to 15% mid-teens type of return on the back end. Certainly less than what we had historically achieved, but our expectation is the next 5 years probably is not going to be as good as the last 5. So with that, I'm going to jump to the end. We can go through each one of the deals. If you come to the table, there's right now 17 properties in Fund 3 that are closed. We have another 3 that are scheduled to close before the end of March. So it'll be a pretty fantastic diversified offering. And I'd like to encourage you guys to come by and meet us at the table. I'm talking tomorrow, and we'll be here the rest of the week. Appreciate the time. Team and track record, guys. Thank you.
Good afternoon, everybody. Great to be here. First conference post-COVID for us. Pretty exciting to be out meeting folks and doing things again. It's really nice. Chris, who was right before us, is right. This is a people business. Let me take a minute, tell you about myself. Then I'll let Sam, my Chief Investment Officer, do the same. And then we'll talk about what we're doing these days. So my name's Frank Saul. I come from a multi-generation family business. I've had the good fortune to work in a lot of different asset classes and structures. I ran a public REIT that's largely in the grocery anchored shopping center business. I've built a couple million square feet of office building. Same with apartments, about 5, 6, 7 now, large apartment buildings, sort of trophy class, and about 24 hotels. Some of that's been in the private side, some of that's been in the public sector, but my whole career has been in real estate. Sam?
So little did I know when I was in high school, cleaning out sinks and fixing locks at the local apartment building, that a career later that I'd end up speaking to you about investing in converting hotels to multifamily properties. My background has been primarily investing in lending in real estate. I met Frank about 20 years ago when I was a real estate lender and gave him access to capital to develop hotels and a couple mixed-use projects all in the Washington, D.C. metropolitan area. In the last 15 years, I've spent investing in multifamily properties, renovation and repositions. I've done about 7,000 apartment homes to date, representing over about $1 billion in real estate transactions. And so when Frank called me about his idea, taking these distressed hotels that are kind of coming out of this COVID crisis, but actually were in distress prior to that, I thought this was a great opportunity to help solve the nation's housing shortage.
So when COVID hit, like a lot of my peers, we started running around thinking about how bad is this going to get, which sectors, where can we buy stuff cheap? And I started looking at a couple of big projects, downtown major metropolitan areas, that looked like they were going to be in trouble and likely not come back. And after spending a little time doing that, I quickly realized all the big New York banks were raising distressed funds. These were great assets, great locations. They were going to get bid up, but the yield was going to go down, and I just didn't want to chase that stuff. I spent some time with my peers in the hospitality industry and really dug into what was happening and where the pain was, and it became clear to me there's a whole generation subset of hotels, think your first generation Holiday Inns, Ramadas, that have sort of slid down the brand flagpole to a lesser tier brand. And those, the economics of reopening just did not make sense. And so with that in mind, we started to analyze the market, started tracking hotels for sale, and started doing due diligence on how to convert those into residential housing. It's a very exciting opportunity. We think we can generate a 20 IRR and a 2x multiple. It's a nationwide problem. Today, there's an enormous amount of product for sale. This is a graph of assets that are in distress, 30 days plus. Industry prognosticators say that could be up to a third of the hotels don't reopen. Sam, you want to add anything to that?
Yeah, I don't know that it will ultimately result in the collapse of a third of the hotel industry, but certainly we're seeing a significant amount of hotels in distress, either coming quietly to us through off-market solicitations or through the brokered community. In the past year when we started looking at this, you look on the internet and see maybe a couple hundred of these hotels listed for sale, most of them for a distress reason. Fast forward a year later, and now it's thousands that you can find. And so there's a pretty good inventory for us to try and solve this mission problem, which is at least put a dent in the housing crisis. So what we've decided to do is look in various markets throughout the U.S., mostly east of the Mississippi, where we're both mostly familiar with our real estate properties. And we look in different jurisdictions. They don't have to be primary markets. They can be secondary markets, just as long as they have good jobs, good transportation, and overall good transaction volume that you can measure in the multifamily sector. We can find these boxes that you can convert from hotel to apartment. Because the reality is these hotel buildings are effectively a similar box to an apartment building. And doing what we're doing is effectively going in and reconfiguring the box to create apartments out of these guest rooms. So when we're all said and done, we're delivering a product to the market that's an apartment building, and it's brand new on the inside. They've got new kitchens, new flooring, everything's painted. On the outside, we dress up, we fix everything up, repaint it, do reliefs. It effectively operates and looks and feels like an apartment building that's brand new, and we're competing against Class B product, yet we're renting at workforce housing rents, which are often a lot lower than what those Class B properties can offer their property at. So in summary, what we're doing is we're doing a value-add reposition, except as opposed to starting with a multifamily building, we're starting with an empty hotel building and then redelivering it as an apartment.
So the team that I have has been with me 20 plus years. Core members of it will be doing this execution. These are some of the properties we've done in Washington, D.C. Ground up, new development, mixed use, renovations of historic buildings, rehab of older buildings, a rehab of a mansion, and a new tower in a very tight site. So we've got a very experienced team that's used to doing complicated projects. This execution is relatively easy for us, and we're excited about getting busy again and getting out there and doing things. So look, our thesis here is compelling returns. Real estate's a great inflation hedge. You've heard that in the previous presentations. And the workforce housing problem in the country is significant and real. And this is a great way to make a decent return on your money and also make a dent in that problem and help solve some of the community strife that we have. Sam, any final thoughts?
Yeah, so I think at in conclusion for us, we're really excited to be in a point in time where we can help contribute to a solution to this housing crisis. We're helping communities. These hotels, they close, they don't produce tax revenues. They also end up at times becoming homeless and crime-ridden properties. And we come in and the communities actually embrace us and really see the value in taking what is a blighted property and turning it into something that's useful and practical for the community. Currently, we're at the front end of this process. We just started, actively acquiring and putting under contract properties that are listed in the market or came to us off market. We've got 4 under contract, and just today we started negotiations on a 5th, representing about $50 million in total capitalization. Our target for this investment is we're trying to deploy about $100 million of equity, and we think that'll take about 10 to 20 properties to be able to fully use that capital. When we're done, we'll be delivering 20 IRRs and 2 times your equity, and we believe that we'll be able to produce those returns on these individual assets over a 4-year hold period.
Thank you for your time. We're actually right outside with a table. If you'd like to talk to us, come on by. Thank you.
Hey, everybody. Thanks for coming out. Appreciate you being here. Anybody know what that song was? Nobody. It's called Runaway by Matt Carney, in case anybody cares. But that's not what we're here to talk about. So we're going to talk about Ashcroft Capital real quick. I'm going to try to get us back on schedule, so I'm going to do a real short little pitch. I don't know what I'm competing for, but I think you're going to like Ashcroft the best. So this is not general solicitation, not a CPA, tax advisor, all that kind of stuff. So please seek licensed advice. I'm just going to show you a couple things about Ashcroft. So real quick, I'm going to start with some quick facts and stats. We've had about a 22% LP IRR in the history of the company. We're a multifamily investment firm. We have a value add strategy. So simply put, we buy apartments, we fix them up, and then we sell them. So if you're not familiar with some of those terms, about a 1.8 equity multiple, which means almost kind of a double your money kind of situation from beginning to end, portfolio wide. Got about 14,000 units, over $1.5 billion assets under management. We've done about 45 communities. We've taken 17 deals full cycle all the way through the business plan. This is some of our team. We've got a huge team. This is just kind of the director and executive high level. You've got Mr. Joe Fairless. Thank you, Joe, for being here and putting on this amazing event. Round of applause for Joe. So, thank you. So Frank Rossler and Joe founded Ashcroft Capital. So Frank came from the institutional side of this business, working for a company called M&A Properties. He did about 7 years there, and M&A Properties had a very similar business model in that they did value-add multifamily syndication. And Frank is one of the smartest guys I know in terms of asset management, underwriting, acquisitions, finding awesome off-market deals. The problem was, as Frank branched away, he didn't have a network, right? He didn't have a huge following or, the whole social media. And so in comes Joe with the best ever brand and being an author, being a podcaster, being a speaker, being an educator, having a following. Joe was, a VP at a huge marketing firm in New York City. And so kind of that's your yin and yang to how and why Ashcroft was formed. So we also we're vertically integrated, right? So we have our own property management company. We've called them Birchstone Residential, and Birchstone Construction is our own in-house construction company. So across the portfolio, the only client of Birchstone is Ashcroft Capital. So Frank heads up that team. There's a few of our executive level there as well. I don't know if you guys can see that clearly. I'm just going to highlight a couple things. These are the 17 assets we've taken full cycle beginning to end through our business plan. The things I want to point out are that we buy 200 to 600 unit properties. We're in the Sun Belt markets. I'll talk about that in a minute. Properties built in the 70s, 80s, 90s, 2000s, and we typically hold for 3, 4, 5 years, somewhere in that time frame. And so this is where we've come up with that 21.7 IRR net to our investors, and there's kind of the data on those sold acquisitions. Of course, past performance not indicative of future returns, but that's what that is. So why multifamily? Well, these stats now are a little bit outdated, but 9.3% 12-month national rent growth. Last year was actually about 11% nationwide, and then, depending on who you listen to, Mark is a Millichap, CBRE, CoStar, we're looking at maybe an 8% forecast for the current year, depending on who you tune into. So we're still seeing rent growth is the point. I think we all know what's happening in real estate. It's been very hot. Now we've got this heavy inflation. Inflation lifts commodity prices, generally speaking, and commodities are basically real estate, right? Because when you're buying a home or multifamily, you're buying lumber, steel, everything that's been going up, glass, et cetera. So 94.9% 5-year average on occupancy. So what we buy are stabilized, cash-flowing, pre-existing properties that out of the gate, we already have high occupancy and high collections. So you lessen your risk with that kind of investment, right? We're not doing ground-up development or anything like that. We're just kind of improving these properties to what the market standards are today in 2022. So passive income is why a lot of people invest in this asset class, including myself. I'm also a full-time passive investor. Done, 12 deals with Ashcroft and 40-something deals as an LP investor. Look at the stock market. Today it was like the NASDAQ opened up 3.5% low, ended 3.5% high. There's a lot of volatility in the market. So if you're somebody looking to diversify, looking for more stable, consistent, kind of predictable cash flow, this might be something to consider. tax advantages, on and on, check with your CPA, but amazing tax advantages. And diversification is why we do it in a fund model. So we might have, for example, 8 of these assets under a fund. And we're not here to talk about the fund, just want to throw that out there. So the Sun Belt market, this is an interesting graph here on the right. So the national average of rent growth, as I mentioned, about 11%, is highlighted kind of in that greenish blue color. That's the national average. The markets that we're in are what you see there that are higher. So we're looking for markets that are above average in terms of rent growth, in terms of population growth. So we're in Jacksonville, we're in Tampa, Atlanta, Phoenix, Las Vegas are markets that we're considering for Fund 2, Orlando, et cetera. So, you know, we're always looking at migration trends, New Yorkers coming down to Florida, Californians coming to Texas. This has been the case for about 5 years. Nothing new, but these are the markets that we're in, generally speaking. So that's my personal cell phone. That's my email. We've got a booth right outside the doors here if you guys have any questions. If you want to go to ashcroftcapital.com/Travis, that's not me, is the next presenter. But anyway, go check us out. Happy to answer any questions you have. Thanks for your time. Appreciate you guys being here.
There are more self-storage facilities in the United States than all the Starbucks, which I drank a lot of today, McDonald's, and Burger Kings combined. In fact, there are more self-storage facilities in the United States than all fast food chains combined, and 1 in every 10 Americans use a self-storage facility. So let's do a little test. Who uses one? Who has used one? And all of you have too much stuff, right? I would argue that self-storage isn't used in America because we have too much stuff. It's because it's a tool for convenience. And during COVID, we saw the highest occupancy, the strongest rents that we've ever seen in the asset class's 40-year history. And it's because self-storage benefits from one thing: life events. And COVID continued to prove that as Americans were on the move in RVs, they closed down their offices, they changed jobs, they moved to the secondary and tertiary markets, self-storage continued to thrive. But let's talk about the last 4 recessions. This shows self-storage occupancy through the last GDP cycles. Consistent returns, and consistently doing well during good times and in bad. And when we saw a lot of this during COVID, eviction moratoriums, government restrictions, self-storage, we saw collections increase somewhere around 30% across our portfolio. And in fact, self-storage was the best performing asset class period during the pandemic, with 12.7% annual rent increases from June of 2020 to June of 2021. So, the word's out, and Public Storage, which you're probably very familiar with, during the pandemic picked up $3.3 billion worth of it. Then Blackstone decided that it was a good idea to jump in, and they bought a branded company called Simply Self Storage for $1.2 billion, and then the hits just kept coming. A guy named Bill Gates, Cascade Investments, bought a major share of Stormart. This is all during the pandemic. Inland monetized a $265 million portfolio. Simply bought another 10,000 unit self-storage portfolio. CubeSmart went on to buy another $1 billion. And the Wall Street Journal finally said, it's the pandemic's hot property. By the way, we bought about $265 million last year. That was a late press release in Q3. So my name is Ryan Gibson. We're with Spartan Investment Group, and we're based right here in Colorado, about 30 minutes from here, maybe 40, in Golden. And last year, Inc. magazine ranked us as the 5th fastest growing private real estate company in the United States, and the 166th fastest growing company in the United States overall. And we operate a brand. Just like Simply Self Storage was picked up by Blackstone, we think that operating our own brand, our own property management, our own standards
provides exceptional value to our investors. So we started Free Up Storage, and that's how we brand every single one of our properties. In 2021, we were named the 90th largest operator of storage in the US, or owner-operator. Our executive team's led by Scott Lewis, our CEO, myself, and Ben Lapidus. And we're a fully integrated company, finding, placing the debt, syndicating the capital. We have our own construction management team in-house that does all of our expansions and ground-up developments, asset management, and property management. Last year, we hired about 73 full-time employees, 22 projects, and built thousands of units through adding or ground-up development. Invest in our values. This is what we're about with our team, our employees, our investors. Our values are defined by our grit. Growth, respect, integrity, tenacity, and transparency. We have about 19,000 doors, 80 employees, 450 AUM, 500 active investors, 150 or so private equity so far, and about 54 locations nationwide. Verifest Verified Gold, that's a tongue twister, if you can't tell. Last year we paid out about $9.1 million in investor profit, and we've had 10 full cycle projects. This is our portfolio across the United States. As you can see, we focus on high growth markets. Eviction moratoriums do not apply to us. We love the Pacific Northwest because of high growth. We love blue states, we love red states, it does not matter. People are moving there and there are jobs. That's the main driver to self-storage. That's where we go. So this is our existing portfolio. You can see we love Texas, Tennessee, Georgia, Florida, where the migration is going. Some of our acquisition highlights from last year. One of the benefits is we're an aggregator of self-storage. So we come in amass portfolios from mom and pop operators, listed stuff, off-market stuff. We aggregate it into a big, huge $500 million or $1 billion portfolio, and then we sell to the larger organizations such as Blackstone, Cascade Investments, NSA, who want to buy a massive amount of storage at one time, or we sell individually, or we break the portfolio up or sell the whole thing. It's lots of optionality in our exit strategy. But it's backboned by our existing assets. And as you can see, we buy a lot of Class A stuff, we build Class A stuff, but then we have the super value add projects where we can move a property a full letter grade up. Take a C vintage property, turn it into a B. Take a B, make it an A. Make a D into a C, whatever it might be. And we expand our properties. So this year, we're excited to announce we're doing a self-storage fund. This will be the Spartan Storage Fund 1. It's a $150 million equity fund. You benefit from the strength of the portfolio of our existing assets and new assets that we bring into the portfolio. And these are all value-add self-storage facilities that project cash flow to our investors and sales upside. So, highlighting the benefits of scale. We have scale in these markets specifically, but across the United States. We have excellent locations, co-located in markets. We have economies of scale by having clusters of property to market where we can reduce payroll, increase NOI, and really have our brand stand out. When you aggregate storage, you get cap rate compression. It's a fact. We had a guy from Newmark come in, brief our company, and out of the 270 transactions that he's seen already this year, cap rates have dropped 85 basis points in self-storage in 1 quarter. The amount of money going into the space is intense, and you have to be well embedded into the industry to take advantage of it. We are. So here's an example property of what our storage fund will target. This is an existing 80,000 square foot facility. It's got some indoor units, some outdoor units, and it has about 735 doors, 80,000 square feet, This is located about an hour south of Dallas. We love the bedroom communities surrounding major metroplexes. High growth market, and the population is going this way. This property came with a car wash. We spun it off. U-Haul rentals on site. We add ancillary revenue. But most importantly, we had 2 acres that we took right here, and we added on 40,000 square feet. So we get the increased cash flow, increased depreciation. This is our construction team overseeing the progress of that extra 40,000 square feet that we built, about 238 units. And we're building thousands and thousands of units across the United States. And this is just an example of what the type of project that our self-storage fund would target. There's some indoor units, there's some outdoor units, great mix. And we work with the local communities to position ourselves to be a well-known facility in the market. So let's talk about our due diligence process. So we put all of our projects through a 700 due diligence point checklist. This is on our website. We communicate monthly. We do an investor quarterly conference call, so you know exactly what's going on. We brief the whole portfolio. We do investor statements and property tours nationwide. This is our investment team. Ed, Ted, and Lauren. They're here at our booth in the back. Thank you for your time, and we'll see you at the conference.
Awesome. Can I get a mic? Thank you. All right, your attention has been very much appreciated, and we're going to reward it with a quick stretch. So, everybody stand up, give your neighbor a high five, and put those arms in the air. Get those wiggles out. Get those wiggles out. All right, while you're doing that stretching, I want to give a little bit of judgment to all of you for not vocalizing your own judgment. I know you have opinions. You came here to have wealth. Wealthy people have opinions. You got to go into that agenda on the Hoover app and give your opinion to these folks. Let them know how they're doing. Let them know where they get approved. Give them that 4, 5, 3, 1-star rating. If you don't want to put your information in there, I know it pops up first. Just drag it down, and then you can go give them that 5-star rating. So we have about 60 people aggressively putting those stars in there, but I see at least 300 people in this room. So keep doing that. You're going to have 30 more hops, 30 more seconds of hops. Get those wiggles, get that stretch, high five your neighbor. And with that said, we're going to introduce the next round of folks. You know them well if you've been to this conference. You love hearing from them. You love looking at them because they're beautiful people. They are in the business. They're training over 100 people in this audience. They are godfathers in the multifamily space. I want to introduce to you 2 rock stars, Mark and Tamil Kenny.
All right. Hello, everyone. Mark and Tamil Kenny with Think Multifamily. We focus on buying apartment complexes, and we also provide one-on-one coaching to help people syndicate multifamily. So quick background about myself. I was a CPA for a while, did IT consulting, had an IT firm, did business manager consulting, and started buying small multifamily properties 28 years ago.
I was a registered nurse and executive admin, and then I was a board member of a couple of nonprofits. There we go, there's my mic. Think Multifamily buys primarily B and C class multifamily assets, 100 units or more. We have over 90 transactions, 14,000 units purchased, and we're in 12 states right now, Texas and the Southeast primarily. This is what it looks like on the map where all of our apartments are.
So when I had my IT firm, I had it for a while. I was working usually minimum 80 hours a week. I was making good money, so my issue really wasn't financial, where a lot of people have that. It was really time. I didn't really have time for Tamil or the kids, so that was really why we started looking at doing larger multifamily syndications. We'd already been buying real estate for a long time, but just by ourselves, and we weren't going to get there making what we needed to do to replace my IT income unless we started syndicating. I love this quote here too. It says, each day of our lives and make deposits in the memory of our kids, but I would say it's not just your kids, it's people you interact with. You're going to leave memories, so you need to make sure this is a relationship business, and you need to be a good buyer, good seller, and good partner. So people that come to us typically for coaching are 9-to-5 job or 9 to whatever they work. They typically want to leave their job, and or maybe they like their job but their spouse is working, they want to retire their spouse. A lot of them have no real estate experience. Some have maybe flipping or wholesaling. Some have some limited multifamily experience, or they just want to go larger. But they all have one thing in common. They want to create financial freedom for their families, and they want to get their time back. When we started syndicating, we were doing smaller properties a little bit too, even first syndication, but we had some issues. We didn't have the net worth liquidity that we needed to do larger properties, so we actually had a partner that helped with that. We really were nervous and scared about raising capital, which average person can't go out typically and buy 100 units on their own. They have to actually raise money from other people. And then we didn't have the partnership experience, for example, with brokers and sellers and things like that. So those are things we struggled with and we saw other people struggle with, so we thought there would be a better way. So we created a group called the Family Syndication Group that works kind of in a family environment. It's a coaching group, but also it helps people invest more wisely, I guess, in deals.
The culture in the family syndication group is very important to us. So to be a part of the family syndication group, we really focus on people who are honest and show integrity, who are humble, who are willing to work well with other people, who have more of a collaborative mindset versus competitive, and being able to help other members also succeed. So even though you've gone and you're successful and you're doing deals, we also encourage our members to invite some of the newer members along the ride for them, doing due diligence or being a part of their deal as well. Our members have been successful in these methods. 74% of our members have gotten into general partnership spots in less than 6 months. We purchased 5,000 units last year alone, and we raised $100 million in equity last year. We believe in doing life together and not just business. We do take a summer trip with our members and their families every June or July, and we have, I think, about 80 to 100 people signed up for the summer trip, so we're really excited to get to network with and meet everybody's families.
But there's no education, it's just
a trip on the
strictly food, beach, and pool, so it's relaxing. But I will tell you, there are more partnerships that get created there on that summer vacation because it's just a relaxed environment. People are there also with their kids, just kind of hanging out, so there are a lot of relationships that happen on that vacation. If you want to learn how our members have been so successful, we do have a session on Saturday morning. We'd love to have you there for that. And we also have a booth pretty much right out there. If you want to chat with us, we'd love to have you there. And then here's our contact information as well if you reach out that way. And we appreciate everyone joining today. And we will, again, if we're out there, if you want to chat with us. So
have a great conference this weekend. Thank you, guys.
Thanks, guys. Thank you.
Good afternoon, everybody. So I'm here to talk with you about impact, specifically impact investing. And we've committed in our investing, we've self-mandated ourselves at DLP Capital, the company I'm the founder and CEO of, and all of our investment funds to make a positive impact across these 4 crises. First is the happiness crisis. In our limited time, I can't get into it in full detail, but the happiness crisis is a pretty unique crisis we're focused on. Second is the wealth or legacy crisis, what some call the shirt sleeves to shirt sleeves in 3 generations. Who's ever heard of that before? A few of you? Okay. Third is the jobs or the American workforce crisis. And fourth, and most significantly for us, is the housing affordability crisis of workforce housing here in America. And that's our biggest direct focus of what we do across our investment vehicles. DLP Capital is a vertically integrated real estate operating company with nearly 500 employees, nearly $3 billion of capital, fully integrated property management, construction management, development, brokerage, lending, fund servicing, loan servicing, title, you name it. All the different components you'd expect of a vertically integrated company. But with everything we do, we can break it all down into what's on this slide. We call our flywheel. This is our strategy of everything we do, how we make an impact across these 4 crises, and how all of our investment vehicles that we're going to get to in a minute all work together. And for us, everything starts at the top with capital being invested into our funds. At our size today, we could take in institutional capital very easily. We've chosen not to. We've decided we want to stay focused on faith-centered wealth creators. Individual first-generation wealth creators typically are who are invested with us, over 2,000 investors that we're helping solve this legacy crisis or the shirt sleeves to shirt sleeves in 3 generations. Second part to our strategy is we invest in housing. So we do a lot of different things. We invest as a lender, as an equity partner to operators like many of you. We invest directly as a sponsor. We do ground-up development. We do value add on existing assets. But at the end of the day, it's all housing. That's what we invest in. Then third, what we do, which is really the secret sauce, is we build elite organizations. We build organizations that execute at a really high level, both the companies at DLP and the operators that we partner with and we lend to. I wrote a book called Building an Elite Organization. I'm actually going to be doing a book signing on tomorrow after I do a talk on what I call the New American Dream tomorrow at 11:15, so please come join me for that. But we build elite organizations and create jobs. And then fourth, if we do those three things well, we create prosperity. And we create prosperity for our four stakeholders, which are our employees or our team members, our residents. We have over 40,000 residents living in the properties we own today, our investors, and the operators that we lend to and we partner with. And if we do that well, more capital comes into our fund. In fact, last year, over $400 million of new capital came into our funds. And this year will be well over $500 million if our investors continue to support us as they have. As I said, my name is Don Wenner. I'm the founder and CEO of DLP. I started the company 16 years ago in Bethlehem, Pennsylvania. Today, we're headquartered out of St. Augustine, Florida, with offices throughout North Carolina, Pennsylvania, and Florida. Today, we have nearly $3 billion in assets. We've been one of the 5,000 fastest growing companies in America for 9 straight years. For the last 15 years, we've grown the organization by 60% or more every single year. We've 10x'd the organization every 5 years for the last 15 years. And that's through elite execution. That's what I wrote a book on called Building an Elite Organization, which was the #1 best-selling book on Amazon, on USA Today, on Wall Street Journal, and what we help implement into the operators we lend to and we partner with. I'm also been married for 11 years, as we jokingly like to say, in a row. And I have 3 wonderful kids, including my newest adopted baby son, Jacob there, who's 5 months old. So I'm going to walk you through 3 of our 4 investment vehicles that we have available today. First and foremost is the DLP Building Communities Fund. Simply put, this fund invests into the development and construction of new single-family and multifamily rental communities. That's all this fund does. We invest in entitled land, taking it through development and construction into stabilization. This fund has a 13% return target, 8% preferred returns paid to investors before we earn anything. And this is an evergreen, open-ended fund, which I'll explain more in a moment. This is an example of one of the assets that is in construction in this fund right now. We call it Dream Kissimmee. It's right outside of Orlando, Florida, 304 units. We'll have an all-in construction cost of about $185,000 a door, and we'll certainly have a value well over $300,000 a door when it's complete. Our second equity fund invests only in value-add existing rental communities. This is called the DLP Housing Fund. This fund owns over 10,000 units right now, over $1 billion. Last year, just in actual realized gains net to investors was over 20% net to investors. We're finalizing the unrealized or valuation increase right now, but we'll be north of 30% net to our investors last year in this fund, investing in value-add multifamily. Again, owns over 10,000 units right now. This is a $1 billion evergreen, open-ended equity fund. It's a private REIT. This is an example of one of the properties we sold a few months ago. This was in North Charleston, South Carolina. We own in about 20 states, mainly in all the places everybody else told you about, all the Sun Belt markets. This is an asset we sold, generated a 30% annual return net to investors on this asset, which was actually on one of the lower end returns of our exits over the past few years. Last year, what I'm going to present on today in terms of our 4 available funds, I'm only presenting on 3 today, as I was told we only had 10 slides, so we couldn't present them all today. But the DLP Lending Fund is our evergreen private REIT mortgage pool fund. So this is a lending fund that lends money to other real estate investors, first position real estate loans. Our other fund I'm not presenting today does subordinate and mezzanine loans as well, but this is all first position mortgages. We've been running this fund now for over 7 years. For 90 straight months, we've generated double-digit returns distributed to investors. So we actually distribute all of the cash flow, all of the income, all of the returns every month. We actually pay out 2 distributions a month, double-digit returns every month for 90 straight months, over a 13% return net to investors, average loan-to-value about 55%, never written off a dollar of principal or interest in any loan. Across all of our funds, we've never had a single month where we've missed preferred returns. We've never had a single loss to any investors, and we've exceeded return targets in all funds. Again, all of our funds are real estate funds, all investing in housing, all open-ended equity funds. One of the most unique things I think about our funds is we make sure we always put investors first. So we make sure all of the income is distributed to investors until they achieve a preferred return. We don't even achieve a management fee, any income whatsoever, until investors have achieved their preferred return in all of our investment vehicles. Here's an example of one of the assets in the lending fund. It currently has over 700 loans to more than 200 real estate operators across more than 30 states right now. So to learn more about our investment vehicles, about what DLP does, you can join us at our booth back here. Tomorrow I'll be talking at 11:15 on a pretty unique presentation I call the New American Dream. And then I'll actually be doing a book signing on building an elite organization following that as well. So thank you, everybody, for your time, and I look forward to getting to know many of you here over the next couple of days. Thank you.
How y'all doing this afternoon? All right, it's been a long afternoon, but I'll try not to bore you up here, all right? I was going to just tell some jokes, but I think I'll jump right into it. So I'm going to tell you about Aspen Funds. We're a macro-driven alternative investment company. We are not just, we're investors ourselves, and we have a following of investors that we're always growing that we invite to come alongside and invest with us. So I'm the handsome guy down there at the bottom, Jim Mafuccio. So I've been self-employed in the real estate world since 1985. How many of you were not born by 1985? A lot of hands. So anyway, mostly that was development, residential infill development, and different kinds of investments. I've been in the mortgage business, originated mortgages and underwritten them, everything else you could do there. About 10 years ago, I discovered, and I discovered it by default, it's kind of a joke, but I discovered the defaulted debt industry because I'd gotten washed out twice by trying to be a developer in Southern California. And when you're private money funded and a small developer in that big ocean and the way the market does what it does there, it wasn't a good business model. I wish I had conferences like this and some of the mentors. I wish I had the 60-year-old me back when I was 40 years old. It would have saved me a lot of heartburn. But anyway, I discovered distressed debt, and I was flat broke, 55 years old, coming out of bankruptcy with 5 teenagers under roof. And I discovered this little thing called non-performing second mortgages, which sounds like insanity, but I started a little beta test with that, me and my son working out of my basement. And we realized, man, this thing is magic, the numbers and the multiples and the margins you can earn. And so I started doing it, and my next step was to go start raising money, and had no idea how I was going to do that because I was, when you're broke, you're not in sales mode particularly. So this other gentleman on the screen here, Bob Frazier, Bob, we had this serendipitous meeting, this coffee meeting, where he asked me what was it that I did, and I told him, well, I buy non-performing second mortgages. And remember, this is in 2012, and he thought I was insane. I said, well, give me 5 minutes and let me show you the numbers on this thing. And of course, he saw it, and he goes, wow, I want in. And he goes, I'm looking for my next gig. Why don't we join forces? So we founded Aspen in 2012. Bob's background, he has 20-plus years experience in finance. He's been a CFO on both the profit and nonprofit side. He's studied macroeconomics. He puts out an economic newsletter. He's been involved in venture capital. He actually started a company in the Midwest. It was the fastest growing tech company in the Midwest. Before the tech bust, there was the tech boom, and he was in the front end of that. And he built up an incredible company, and he actually was named the Ernst & Young Entrepreneur of the Year winner for that, and one of the fastest growing companies, as I said, in the Midwest. But he had gotten dumped out with the tech wreck. So we like to talk about comparing the size of our craters that we made. And so it was good timing for us to hook up, and Bob is really good at scaling a business. So we started that in 2012, and we literally we're still running that business model as well as an income model where we buy reperforming and other cash flows secured by real estate. And those are evergreen. We're going to continue doing, as long as there's deals, we're going to keep doing those. So the next two members of our management team for Aspen Funds, Dan Schulte Dan has 20 plus years experience in asset management, private equity. This guy's a powerhouse. He's an attorney as well as a CPA. And he actually was a senior vice president and chief counsel for a small company called Waddell and Reed. And they're a mutual fund company I think they're knocking on the door of $500 billion in assets under management. And Dan was their senior vice president and chief counsel and was very, very involved and instrumental in that growth. So when this guy came and started talking to us, I thought it was because he wanted to buy us. But he actually said, no, I want to work with you guys. I want to help you continue to scale your business. I like you guys. I like your business model. Let's do this thing. So we're just super, super honored to have Dan with us. And then Ben Frazier, he joined us about 4 years ago. And he comes from a commercial lending background, super smart guy. Was you can see his college accolades there. But he worked as an underwriter in the commercial lending world, underwrote $125 million in commercial real estate. Before that, he worked for a boutique asset management firm, and he managed accounts from $3 billion assets under management to $7 billion. So Ben's the young buck amongst us. In other words, he's under 40. So it's great to have. The reason I spent a little bit extra time on our team and our story is that really is our secret sauce for the next phase of our business, which is not moving out of distressed debt, but we've added to it. So we're now investing across a spectrum of alternative assets. And if you look at this little chart on the left, we kind of look at life in those terms. There's kind of a progression of passive investment that many of you are in one or more of those stages right now. And so right now we're focused in the level 2 passive real estate, and then the private equity venture capital world. We're not really so much involved with hedge funds at this point. And then on the right, you see there that pie chart. Now, this is really interesting. So there's a group called Tiger 21. How many people have heard of Tiger 21? Okay, I see a few hands there. So it's this elite kind of membership-only thing, invitation-only thing, but it's ultra-high net worth individuals. And this is the way they allocate their investable funds, and it's pretty telling here. So you can look at those top 2 biggest pieces of the pie are real estate and private equity, and then the lower right-hand corner, public equities, and then of course you have cash and cash equivalent is that dark blue one there, 13%. The point is we saw this, and yet we know that there's trillions of dollars in the hands of people that don't know that people like us, the sponsors that are at this conference, exist yet. So they're not investing, they're not allocating money into private placements or syndications or what we call alternative investments. Now, they've begun to, and it seems like everybody's doing it now, but the fact of the matter is that we're still at the beginning of this kind of this renaissance. And so what we are positioning ourselves to be is both an educator, a networker, and a very active investor ourselves in passive investments. And then we're inviting people, our investors and our following, to come alongside of us on this journey and become like those ultra high net worth individuals. So our process and our value proposition, first thing we do is we identify key macro trends that are in play and likely to continue. My business partner Bob likes to say we like to invest based on the tides, not the waves. Okay, so big macro movements. So we find the best asset classes in those macro trends, and then we identify the best in-class sponsors, and we perform due diligence not only on the deal but on the deal sponsor. So our value proposition is we co-invest in every deal. We're not just brokering money back and forth. We do extensive due diligence. We oversee the sponsor performance and accountability, and we report back to our investors. So we are our investors' advocate. And then we don't get paid. We don't take a cut of our investors' money. We work our deal with the sponsor, and so our investors getting the value of us doing the due diligence, vetting the deal, putting our own money in it, and then they come along with us. Current macro trends that we're enthusiastic about. Yes, inflation, we're enthusiastic about it. Incredible opportunity to exploit leverage in this kind of a market. Strategies, our multifamily, self-storage, we're involved now in both of those. Supply shortage is another macro trend. We see that especially like in all kinds of housing, especially multi, and in industrial right now. I mean, there's users looking for space. So The way to exploit that particular macro trend is by developing. You got to build it. It's better to build than to buy. So we're involved in 2 development projects right now, 1 storage and 1 industrial warehouse. And then there's inefficient markets, and these are things that are acyclical or evergreen, like our distressed debt fund. There's always distressed debt. Of course, when we got into it, there was a big bubble of that because of the mortgage crisis. But there's still a good deal flow in that, and so we're very involved, and we'll always be involved in distressed debt. We're also getting involved in venture debt. So our track record, well, you guys can see that slide for yourself. We've been around a long time. We've raised and deployed $80 million in private capital. We've invested in 50 states, et cetera. So finally, I'd just like to talk to you about we have a podcast, Invest Like a Billionaire. I highly recommend you get on that. That's not us pitching deals. We interview, some of the people that we interview are actually speakers that'll be at this conference. And we teach you about, we bring in experts on wealth, growth, wealth management, asset protection, and different business models and what's working in today's climate. So I'm gonna end there. Thank you so very much for your attention, and have a great rest of the conference.
Hey everyone, I'm Annie Dickerson with Good Egg Investments, and I'm thrilled to have the opportunity to be here with you today. Now, I know a lot of you are looking for passive investment opportunities, which you've heard some great ones here today, but I also know there are a handful of you looking to raise capital for and syndicate your own deals. So if that's you, for the next 10 minutes, that's exactly what we're going to talk about, because I want to set you up for more success than you can imagine. So you can go from raising under $500K to raising millions of dollars for your deals. Who's up for that, huh? All right. So first, let me start by telling you a little bit about why I'm uniquely positioned to be up here talking to you about raising capital. You see, 5 years ago, I didn't know anything about this entire world of raising capital. I was working as a creative director, 6-figure salary, full health benefits, the works. And my kids were young then. They were just 4 and 1. So I had every reason to continue down this stable and secure path. There was just one problem. I wasn't fulfilled. I had everything, the kids, the husband, the house, the job, but I couldn't have the impact that I wanted to have. And so I felt stuck. I was stuck because I wanted to replace my income, but I didn't know how. I tried all these different side hustles, and they didn't get me very far until I found real estate. And I instantly fell in love because I saw what it could do for me and my family. And not only that, I saw the potential for real estate to bring my friends and family alongside me and change their lives too. Now, the thing is, I knew I couldn't just do this 1 foot in, 1 foot out. I had to let go. I had to let go of that creative director lifestyle, get rid of the safety net, and take a leap of faith. Now, that decision, though, to quit my job, it was anything but easy. And I remember that exact moment I made that decision. I was sitting at my kitchen table, tormented about this decision. And here's what I did. I took a piece of paper. This is the exact page from my notebook from that moment. I took a piece of paper, and I divided it into 3 columns. In the first column, I wrote down the dangers of quitting my job, all the fears rattling around in my head. And I thought there would be so many, but in actuality, there were only a few. So then I moved on to the opportunities, the impact that I could have, the people that I could help, the legacy that I could create, and the freedom that I could achieve. And then finally, I moved on to the strengths, all the reasons to bet on me. And when I put down that pen, I was bawling right there at my kitchen table because I knew in that moment, looking at that piece of paper, I knew what I had to do. But that doesn't mean the fears were instantly erased. I was still scared out of my mind. But here's what I did know. I knew I had 2 key things going for me. I knew I was committed, that I was going to make this happen no matter what. And I knew I had this deep-seated passion to help other people, and I suspect that a lot of you have that passion as well. So despite all my fears, my hesitations, my lack of experience, I did it. I took the plunge in 2018, and I quit my job, and guess where I was? Literally the week after I quit my job, I was right here at Best Ever. Only things were a little different then. I didn't know anybody here. I had never done a deal before. I'd never raised capital before. I didn't have a company. I didn't have a website. My business cards still had my personal Gmail address on them. And oh yes, I'm an introvert. So all the odds were stacked against me, but I was committed, remember. So I pushed myself beyond my comfort zone. I did so every day at that conference, and I've been doing it every day since then. And so fast forward to this year at Best Ever, things are a little different now. It's been about 4 years since I first came to this conference, and about 4 years since launching Good Egg Investments together with my fabulous business partner, Julie Lamb. And in that time, we've done over 35 syndications across over $1 billion in assets. And not only were we able to help a small circle of family and friends, we've helped thousands of investors to change their lives too. And the reason I'm telling you this is because I want you to see what's possible when you've got the commitment and you've got the passion. Even if you have some of these fears rattling around in your head right now, if you push through, you can find success too. And I want to help you to get there. Now, in order to do that, I want to take you back to the first deal that Julie and I did way back in 2018. Now, at this point, Julie and I had had several conversations with family and friends, and they seemed interested. So we said, yeah, we got it in the bag. Let's go find the deal, because if we find the deal, the money is going to follow, right? We've all heard that one. And so that's what we did. We went out and we found the deal, and we committed to $1 million right off the bat. It was a huge number for us at the time, but we thought, we got this. And so we went after that million, but when we went back to those same investors, it was a little bit of a different story. They weren't ready. They had lots of questions. They didn't understand the process. And so no matter what we did, they didn't want to invest. And so here we were, crushed, defeated, humiliated on our first raise. At the end of the day, we had to go back to our partners and tell them we couldn't hit $1 million, couldn't hit 800,000, couldn't hit 600,000, couldn't even hit 500,000. We ended up with 420K, which included 100K from me and my mom. Yes, my mom. Always can count on your mother. But the thing is, it wasn't just the shortfall that was devastating. It was the fact that we had put so much work into this. Julie and I have 5 kids between the two of us, so we have way better things to do than to chase investors. So it was that we had put in so much work, and we had that big shortfall, and we thought, we can't keep doing this. We've got to figure out a better way. And so every deal from then, we tried something different. And so that 420K, we worked harder for that than we did for the 18 million we just raised on our last deal just a few months ago. And that delta is what I want to talk to you about, because what if I told you there was a way that you could bypass all of those mistakes we made and get right to the gold, get right to raising the capital without the hustle and the grind. And that's what I want to set you up for. Let me tell you what happened next in the story. After the dust settled on the 420K, Julie and I said, never again. What got us to 420K is not going to get us to $1 million, $5 million, $10 million, and beyond. We had to rethink and reinvent every part of our business. And in doing so, we became obsessed with the investor experience. We wanted to know who they were, where they were from, where they were going, what they were worried about, their fears, their aspirations, all of it. And we started to chip away at that with every deal we did after that. And we started to create a system that worked for turning our investors from reluctant observers into raving fans. And at that point, we knew we didn't just have a real estate company. We had ignited a movement. And if you're sitting here today, I want you to know that you have the power to ignite your own movement. You have the passion. You have the commitment. You may even have a lot of the pieces in place. But maybe you don't know the path forward yet. And that's really why I'm here. Because I want you to be able to leverage what we've built so that you don't make the same mistakes. You don't have to reinvent the wheel. You can go farther, faster. Now, if you're ready to break through, and go from raising less than 500K to raising $1 million, $5 million, $10 million for your deals, then friends, I invite you to sign up for a capital raising laser coaching session with a member of our team. We'll dig in with you on where you are in your capital raising journey, where you want to go, and the steps in between to get there. Now, through our full Real Estate Accelerator program, we've helped hundreds of people, fellow syndicators, many of them sitting here in the audience, to raise capital for their syndication deals, and we're ready to help you too. So, if you're ready, come by the Good Egg Investments booth, right over here next door, and come for a capital raising laser coaching session. Or better yet, you can scan the QR code up on screen right now to book your session before we book up. All right, with that, it's been a privilege and an honor to be here with you today. On behalf of the Good Egg Investments team, I'm Annie Dickerson. Thank you so much.
Hello, everybody. If some Earth, Wind, and Fire doesn't get you pumped up, I don't know what will. Thank you for that. So again, my name is Walker Meadows. It's great to be with you guys today. So I have a question. And the winner of this will get a prize. So everybody tune in. If you had to guess what the percentage increase in household income was in the US from 1985 to 2020, what would you say? Raise your hand. Anybody? Or just shout it out. 100%, okay. 350%, okay. 400? Okay, all right. 100 in the back is closest. It was a 25% increase since 1985. Okay, all right. Now let's do that again, but this time we're going to look at median home price in the U.S. What was the increase from 1985 to 2020? 800%. Okay, next. 400 and 300. Okay. 400 wins. All right, so you two guys meet me after the presentation for we'll meet up for a drink. But yeah, so the median home price in the U.S. has increased 396% in the past 35 years, whereas median household income has only increased 25%. And so what does that mean? This is a housing affordability crisis, right? And you guys hear this, we've almost become numb to this crisis term. But I just want to paint for you guys a picture of how severe this crisis is in the U.S. right now. And how many folks is like in your markets back home? How many folks saw their home prices go down in the past 12 months? Nobody, right? So it's only getting worse. Those stats are only through 2020. So today I want to tell you about how Open Door Capital is our investment thesis is centered around this topic of affordability and the crisis in the U.S. around that topic. So who am I? Walker Meadows. I'm COO at Open Door Capital. This is my wife and my 2 kiddos and one of my 2 chickens. We live in Atlanta, Georgia. And anybody else from Georgia in the room? Okay. You can relate with the nasty Georgia snowman in the bottom left of that slide then with the clay at the bottom. Any of my southeastern folks can relate to that. So I've been with Open Door Capital since inception. I run our whole company. And yeah, that's pretty much me in a nutshell. So, disclaimer language, probably the 100th time you've seen this today. I'm not going to go through it. Turn on your turbo reader eyes and you know what it says. Past performance, not indicative of future projections, performance, all that jazz. So, what is Open Door Capital? Raise your hand if you know this guy. Who is it? Brandon Turner, right? So Brandon Turner is probably best known for his time at Bigger Pockets. He actually just stepped back from Bigger Pockets at the end of last year, but he's led their podcast for many, many years with over 100 million downloads. He's also published over 7 books and sold over 1 million copies. So he is actually the best-selling real estate author in the world. So just a quick point of clarification, Open Door Capital and Bigger Pockets are not affiliated. We get this a lot of times from prospective investors, like, oh yeah, I know Brandon from Bigger Pockets, so Bigger Pockets owns Open Door Capital. 2 totally different ventures, both from involving Brandon though. So Brandon birthed Open Door Capital basically out of necessity. So about 3 or 4 years ago, Brandon was starting to make a lot of money from his book royalties. and needed somewhere to place that capital, and there weren't a lot of good options for him to invest in. The kind of a theme that he saw throughout the kind of syndicator market was that folks were either too heavily appreciation focused or too heavily cash flow focused. So he wanted to create what we call a cash growth fund. So similar to some of the pitches you've heard today, we focus on assets that produce cash flow in the early years, and then that cash flow scales over time, and also with the ability to execute forced appreciation on those assets. And so that's what he wanted to do, but he also wanted to pick a defensive asset class, because 3 years ago he thought we were headed, or we could be headed into a recession. So we wanted to be in a defensive asset class. And given his exposure on the Bigger Pockets podcast, mobile home parks was something that had always piqued his interest. So he dove into mobile home parks head first. So this is actually Brandon's house on Maui. So funny story, Brandon met this guy named Ryan Murdoch. Ryan, can you stand up? Are you in the room? Wave your hand. Yeah, so Brandon flew Ryan out to his house from Maine, and I think you guys had met one time, and for some reason he flew you to Maui to help him move. And then Ryan basically never left. So Ryan lives in Brandon's shed behind his house, basically, and has been there for years. So Ryan was instrumental in helping birth this idea. Ryan has extensive background in property management and in mobile home parks specifically. So he and Brandon, noodled on this idea and kind of birthed it. And for anybody that's curious, that white shed at the front of the slide is where Brandon used to record the Bigger Pockets podcast. So the third amigo, so Brian Murray. Does anybody know Brian Murray? Has also published 2 really solid books, Crushing It, and also has just recently co-authored a book with Brandon Turner called The Multifamily Millionaire. He sold probably over 200,000 copies of across these 2 books he's written. So Brian, up until about 3 or 4 years ago, had scaled a big portfolio up in upstate New York and wanted to get out and do syndication. So he went to a mastermind in Maui that Brandon was hosting, and they met for the first time. And actually, while they were out paddling out surfing, they both realized that they had pretty similar interests. So they decided to join forces on Open Door Capital. So this was the original kind of trifecta. Brandon Turner, Ryan Murdoch, and Brian Murray. And ever since then, it's just been an absolute rocket launch. So today we have 25 plus employees. We're all remote all across the US. If you work for Open Door Capital, can you stand up if you're in the room? So we got Mike Williams here, our head of investor relations, Chris in the back in black. He's also on our investor relations team, and Ryan Murdoch, who already stood up. If you have any questions about Open Door Capital, we'll be around for the whole conference, so come flag us. And this is our executive leadership team. This is kind of what our portfolio looks like right now. Still primarily mobile home parks, although we are scaling into apartments. We have about $280 million in assets under management. We've raised about $120 million in equity over the past few years, and we have about 4,000 units under our management as well. We're vertically integrated. We do have in-house property management company that has about 15 or 20 employees. So to get into the meat and potatoes a little bit, so why mobile home parks? I'm gonna breeze through this. So, like I mentioned, this is one of the few remaining non-subsidized forms of affordable housing in the U.S. And the affordable housing crisis is at an absolute fever pitch. So this is a trend that we believe is going to continue and only increase. So we like to be in an asset class that's defensively positioned for a potential recession and also that has increasing demand, right? And then on the other hand, we want to see diminishing supply, right? So in real estate, we want to be at the confluence of diminishing supply and increasing demand. So there's roughly 40 to 50,000 mobile home parks in the US. About 1% of those we lose every year due to rezoning changes or redevelopment. So what you have is a diminishing supply of mobile home parks throughout the US with a crazy high demand, which is great, right, if you're in real estate. High barrier to entry. We get financials from some sellers on paper napkins, right? Like, it's not easy to underwrite these deals. There's still a lot of mom and pop owners out there. And so there's a high barrier to entry in terms of underwriting and offering these deals. And it still remains to be relatively fragmented. There are a number of mom and pop owners still out there, which means there's some good deals to be had, which you guys know. And it's recession resistant. So mobile home parks have performed better than almost every other asset class through both the Great Recession and through the COVID pandemic, which we love. And I'm sorry if any of you guys are hungry, but this is our roll strategy. So this is the type of parks we want to buy. We want to buy parks with resident-owned homes with the opportunity to infill, meaning they might have some vacant pads. We can bring homes in and increase the occupancy, thereby increasing the value of the park. And we also want them to be large enough for management, located in populated, stable areas, but we do buy nationwide, as you saw, and we want the possibility to be able to sub-meter the utilities. And just to give you a little snapshot about our first exit, we exited our first fund last year. Got about a 1.7 equity multiple for our investors. We exited about 5 years ahead of schedule due to our business plan implementation. Got a 35% plus LP IRR for our investors on that deal. And not to mention for our funds that we currently have in the pipeline, we're well over budgeted NOI for those as well. And we may be evaluating some exits later this year from some of those. So what does 2022 look like for us? Fund 6 will be the first opportunity we're going to be rolling out soon. So if you take out your phone and scan this, we do have Fund 6 that's launching soon. We typically fundraise all of our equity within 6 to 7 days. And so if you scan this, we are going to give priority access to anybody that's in the room that signs up for our list via this QR code. And raise your hand if you like alcohol. Okay, and now we're talking. We are also going to have a happy hour at the Numbers Lounge right after this. So it's the Mountain Pass Sports Bar, I believe it's called. There's a section of that called the Numbers Lounge. We have a huge bar tab. Would love to treat you guys to a drink, talk to you more in depth about what we do at Open Door Capital. And so that's us at Open Door Capital. I really appreciate you guys listening. And cheers to a great 2022. Thank you.
All right, that was less than Chris Benson's clap for the second presentation. So anyways, thank you for staying. This is always the difficulty with going last. But I am honored to be the last thing standing in your way of an ice cold Coors Latte, as the locals call Coors Lights out here. I have lived in Denver 3 different times throughout my journey over the past 10 years, so Coors Lattes, they just taste better and hit harder out here. So anyways, let's jump into it. All right, a little about BAM Capital. Being headquartered out of Indianapolis is key to our Midwest focus and successful track record over the past 12 years. It's been an honor to be ranked 4 consecutive years in Inc. 5000, and none of that would have been possible without the over 120 BAM fam, as we call them, the family at BAM Capital and the BAM companies. I think it's critical when you're trying to scale any company that you need to have a visionary and an integrator at the helm. The integrator is who keeps the trains running on time, while the visionary sets the routes that those trains are going to take on a day-to-day or yearly or 5-year basis. At BAM Capital, we're extremely lucky to have both a visionary and an integrator leading the way. Ivan Barrett, founder and CEO, would be the visionary, and Adam, president and COO, is the integrator. The combination of those two are critical to BAM Capital's success and track record. A couple key stats on BAM, and a couple other presenters have mentioned this. We've never missed a preferred payment over our 12-year history. We've never lost limited partners capital. And if you look at our track record, which we'll get to on the next slide, we've averaged over a 31% IRR. When we take a look at this track record right here, this is a realized third-party audited track record that shows that 31.24% average realized net IRR. So when we take a look at this map here, you can see that Indianapolis or Indiana is the darkest color orange. You know, what really started out as a very local mom and pop syndication where most of the LPs were family and friends. And now, over the past 12 years, we've grown into a national multifamily syndication with LPs really in over 42 states as of now and over 600 limited partners. But I think the coolest stat on this page is over 60% of our limited partners have invested in multiple deals at BAM Capital, and over 150 of that 600 LP base has come via referrals. You know, I think those two data points show what the LPs at BAM Capital think about the track record, the results, but also the ethos and how BAM Capital does business. You've heard this a couple times, and I think it's less common in this space, but BAM Capital is fully vertically integrated. So the BAM companies consist of BAM Capital, BAM Construction, and BAM Property Management, which I think is critical when you're looking at modeling. It helps with consistency and predictability in the early stages of modeling. And I think it's important when you're an investor in this space to look for those syndications that have that fully vertical integration built in. So let's transition, now that we talked a little bit about BAM, into the investment strategy. So BAM Capital focuses on Midwest apartments in secondary and tertiary markets with in-place cash flows in the fund model currently to provide extra diversification. We believe that the Midwest, the non-boomer bust nature of that market, helps bring some of the best risk-adjusted returns out there in the multifamily space. So when we look at the past three funds, we'll start with Fund 1 here that closed in 2021. This fund targeted late 1990s, early 2000 assets that needed light value add. When we look at Fund 2, obviously we noticed, like everybody else, cap rates were beginning to be compressed. We saw the value add space starting to be bid up, and we pivoted towards a newer asset, 2015 or newer, that had inflated expenses, under market rents, and could really benefit from our vertical integration in leaning on our property management side of the business more so than the value add side from the construction side of it. And when we look at Fund 3, which we just opened up, we're focusing on recapitalizing 6 known assets in an award-winning secondary market of Indianapolis that focuses on expense efficiencies and executing that full value add play that can only be done from a fresh capital stack that wasn't anticipated back when Fund 1 launched. So I think when you look at these 3 different funds, 80% of our investment thesis is intact in all 3 of these, and our vertical integration is used in all 3 as well. But it shows you that BAM adapts with the market, but also stays consistent to that investment thesis. All right, so why Indiana? We think Indiana is one of the most business-friendly and rent-friendly states in the country. Why Indianapolis in particular? Nearly 80% of the nation's population can be reached within 1 day's drive. Think about that stat for a second. That's truly why it's called the Crossroads of America. And when you have that ability to reach that many people in a 1-day drive, it's no wonder that FedEx, Walmart, Amazon, these large distribution hubs are popping up all over the Indianapolis metro area, and they are becoming either the first or second largest distribution hubs for FedEx, Walmart, or Amazon in the country. And with that comes a tremendous amount of jobs and renters. You can see BAM's footprint right here, showing you our Midwest focus. We have newly gotten into Iowa, and we look to further expand into the Iowa market, specifically Des Moines, as well as secondary and tertiary markets in Ohio. States that we're looking to get into would be Missouri and Kentucky as well, to continue to round out and press in to the Midwest focus that we offer. If you're interested in hearing more about the unique recapitalization in Fund 3, come talk to us. And while a lot of other multifamilies are focusing on, the Sun Belt, I feel like BAM Capital is one of the few that strictly focuses on that Midwest market, that non-boom and bust, with over 40 years of 3% or higher rent growth. And we have a unique value proposition there. So thank you for your time.
All right, folks. Well, thank you again to all of our speakers today. Thank you to all of you for sticking around. Tomorrow, we have a celebrity in the house. He's spoken to arenas of tens of thousands of people about his macroeconomic predictions. Spencer Levy is going to be here. He is a chief officer of CBRE, one of the largest brokerages in the world for commercial real estate, and he is a famous speaker. So have fun tonight. Make sure you're here. Our show starts at 8 a.m. We're going to go over who won the pitch competition tomorrow morning. We're going to leave open the polls for all 12 for another 15 minutes. The DLP got launched a little bit late, so if you want to go in and vote one more time, please be sure to do so. Looking forward to seeing you guys tomorrow morning. Have a great night.